A threatening banking crisis is unfolding right before our eyes, and experts alert this might spark the worst financial crash and the deepest housing collapse in history. Months in a deep, challenging recession, we've already seen several damaging disruptions to our economy, such as the record unemployment, failing small businesses, and the broken supply chain. However, lockdown repercussions are still triggering further threats to our already beaten economic scenery, and those might be silently sitting on the balance sheets of the big banks. According to specialists, a looming banking collapse is unfolding, and its effects could be cataclysmic. Their warnings have generated a heated debate over whether a banking crisis in the same mold as that witnessed during the 2008 global financial crisis is just around the corner. That's why today we decided to investigate what's been going on in this industry to understand the implications of this broad spectrum meltdown. So stay with us. Don't forget to give this video a thumbs up, share it with your friends, and please subscribe to our channel to keep updated with the next chapters of the 21st century depression. A while ago, Berkeley Law professor and ex-Morgan Stanley derivatives structurer Frank Partnoy released an article explaining how a banking crisis has been quietly developing in the U.S. economy background, and its effects could potentially lead to a much more dramatic disaster than the one unfolded in 2008. He said, "You may think that such a crisis is unlikely, with memories of the 2008 crash still so fresh, but banks learned few lessons from that calamity, and new laws intended to keep them from taking on too much risk have failed to do so," Partnoy disclosed. He continued, "As a result, we could be on the precipice of another crash, one different from 2008, less in kind than in degree. This one could be worse." You may be wondering why this time around things could be worse. Haven't banks learned their lessons from prior crises and tightened regulations? Well, according to Partnoy, they did learn some lessons, but that doesn't mean they won't make the same mistakes. The author explains that the financial crisis of 2008 was about home mortgages. In sum, hundreds of billions of dollars in loans to home buyers were repackaged into securities known as CDOs, which stands for Collateralized Debt Obligations. Now, CDOs were supposed to shift risk away from banks, which lend money to home buyers. However, banks started betting on CDOs, and when the housing market collapsed, these banks were doubly affected, losing billions of dollars. 1 year later, Lehman Brothers' crash took the economy down with it. The federal government intervened and rescued the banks, but by then, millions of Americans lost their wealth, they lost their homes, and they lost their jobs. Attempting to avoid another crisis, Congress passed new regulations in which banks were supposed to borrow less, to make fewer long-shot bets and be more transparent about their holdings. Also, it revised credit rating agencies' regulations, because after lending massive amounts of dubious CDOs to unqualified borrowers, these agencies were seen as the main enabler of the meltdown. Even though the reforms had good intentions, it didn't take long for banks to start returning to their old bad habits. They shifted the demand to a similar kind of loan named CLO, or Collateralized Loan Obligation. CLOs were destined for companies that have exceeded their borrowing limit and could no longer sell bonds directly to investors or qualify for a traditional bank loan. Currently, there are more than $1 trillion worth of leveraged loans outstanding. The majority are held in CLOs. The problem with these loans is that their ratings might be misleading, mainly because CLOs are, for the most part, constituted by loans to businesses that are already in trouble. And also there's a hierarchy within its structure, in which the higher layers of investor holdings are less affected than the lower ones in case of a collateral default. As Partnoy explains, for CLOs, the rating agencies determine the grades of the various layers by assessing both the risks of the leveraged loans and their default correlation. In simple terms, it is designed to minimize the chances of all loans to be affected by a single event or a chain of events. But at the same time, it's founded on loans conceded to businesses that are already in the path of failure, primarily protecting higher investors who detain the safest holdings. Yet, the banking industry is highly susceptible to the housing market, which for its part is highly affected by rental default. That's to say, due to the widespread lockdowns that shut business activity down, leading many to pile up monumental rates of insolvency, banks are already seeing the foundation of CLOs disintegrate, while loan defaults are soaring continuously. In fact, in April, it was registered the highest spike in defaults. And Partnoy says it's all downhill from here. At some point in this downfall, large ruler corporations will start to crumble. Amongst the primary liabilities are healthcare and medical staffing companies such as Envision Healthcare, and also Halfmaster, which makes products used by restaurants to package food for takeout. As the banks do not disclose which CLOs they hold, many names only will be known when it's too late. Added to the intricacy of this crash is the expected federal response. Since the Fed issued its money printing policy to rescue the financial markets, one of the possible outcomes is that it will try to buy those risky holdings to prop up the financial sector, as it did in 2008. But Congress will probably react, considering the huge federal debt that still has to be assessed. In the absence of additional federal stimulus, we will also see escalating rates of eviction, aggravating the housing crisis. Princeton University's Eviction Lab, which tracks these rates across 17 United States cities, documented 58,612 evictions as of October 3rd. Researchers forecast that, quote, millions of renters will owe significant back rent, and anticipate a displacement and eviction crisis will follow the public health crisis. Therefore, adding the growing corporate loan default, banks will soon get overwhelmed. So when the faltering bank fails, others will be lined up behind it. And then, sometime in the next year, we will all stare into the financial abyss, says Partnoy. He continues, at that point, he says, we will be well beyond the scope of the previous recession, and we will have either exhausted the remedies that spared the system last time, or found that they won't work this time around. What will happen then? It's anyone's guess. This week, the biggest U.S. banks are due to report their earnings for the third quarter. These results will give a better overall picture of how the financial industry has been navigating through so many harsh headwinds. Up until now, according to Bloomberg analyst estimates, the four largest lenders are setting aside $10 billion in reserves, which corroborates with Partnoy's assertion that the worst may yet to come. This week's earnings report will provide more details on the role that these big banks are likely to play in the next chapter of the U.S. healthcare and housing meltdown, and when some of these reserves may be deployed, impacting net income. Analysts have been arguing that if the U.S. economy has any intention to alleviate or prevent this collapse from spreading across all sectors of the economy, it has to start calculating the risks of reopening the economy. Evidently, lives should be prioritized, and everything must follow strict health safety measures. But if action isn't taken sooner rather than later, the costs of keeping the economy closed will will become more than the country can bear. Partnoy completes that, moving forward, banks should play a much simpler role in the new economy, making lending decisions themselves instead of farming them out to credit rating agencies. They should steer clear of whatever newfangled security might replace the CLO. To prevent another crisis, we also need far more transparency so we can see when banks give in to temptation. A bank shouldn't be able to keep $1 trillion worth of assets off its books. Different from other sectors, when the financial sector breaks, essential aspects of modern life could go down with it. For instance, we could lose the ability to get loans to buy a house or a car or to pay for college. Without reliable credit, many Americans might struggle to pay for their daily needs, the author points out. You know, it's a disconcerting fact that the present situation has become so disastrous, partly because the banks felt they could dive right back into their bad behavior after the last crash without taking the consequences into consideration. They've taken too many risks, masking debt with complex instruments and off-balance sheet entities, and often exploiting loopholes in laws designed to rein in their greed. Rescuing them for a second time this century will be much harder.